Hey guys, welcome back to the channel. It's me, Adam. We're watching Steady Invest, and I finally got a new computer. The last few weeks were a bit rough for me. My computer died. I was unable to make videos. I do have a bunch of ideas, and I couldn't make them. So finally, here we are. So welcome back, guys. If you are new, welcome. Make sure you like, comment, subscribe below if you like the content. And before we begin as well, I owe a shout out to a friend of mine or one of my boys. His name is Mo. He works with me, so Mo, this video is dedicated for you, my friend. So today we're going to be talking about Steady Invest's 4 levels of stock investing. Emphasis on investing, we're not trading this. This is for our long-term investments. With each level, there's more work, and by work I mean more due diligence and more research on exactly what you're buying. But it isn't more effort per se. It's not like you have to check it every day. The beauty of every level is that you can buy whatever you want to buy and then hold it for that amount of time. However, the higher the level, the more risk you're taking, but it's substantially more rewarding than the previous level. And again, if you have a proper strategy, a proper goal, and you know what you're doing and you're sticking to it, then it really isn't that risky if you're looking at the long term. Level 1, we have mutual funds. If you know me personally, you know that I hate mutual funds with a passion. I'll get to that in a moment. What are they? They are essentially baskets of stocks. So every rectangle or every square you see here represents a different stock, whether it's from a different sector or a different country. They're very diversified in nature, and it's the bank that manages them. So the main reason why I do hate them is because they charge an absurd, so MER stands for management expense ratio. So they take 2.13% of the total value of your account, whether it goes up or down every year. And I know it may seem like, oh, it's only 2.13%, it's whatever. It makes a big difference, as I'll show you guys in a moment. Another big misconception out there is that because you're investing with your bank, it's less risky and you feel more comfortable. However, you're investing in stocks that just as if you were investing yourself kind of thing. Yes, it is diversified. Yes, you have someone who's actively managing for them, but it doesn't eliminate the risk the way most people think it does. And the reason why banks justify this fee is because you have someone that's actively managing your account. So for instance, let's say one stock is doing really well and one's doing really poorly. They'll sell some of this stock and they'll buy some of this one to even things out. However, there is a lot of research out there and a lot of statistics that say that this is counterproductive, and it would have been much more efficient had it just been left alone. I believe it's 80-something% that if mutual funds are just left alone, then 80% of them would do much better. And so your manager's trying to beat the market for you, they're not doing that, and you're paying them. It makes no sense. So this particular fund here, it's called TD Comfort Growth Portfolio. This is the ticker symbol for it. And it's for people that want to invest for a long time but don't want to have too much risk. You can see here it says medium risk. And this is how well it's done over the last few years. So from 2015 and onwards. So I'm going to show you guys what the fees would be like if you were to invest $100,000 on January 1st of 2015. Alright guys, so you can see here in 2015, January 1st, we're putting in $100,000 as a lump sum. We're going to also assume that we're not adding our monthly paychecks or anything. We're just going to put $100,000 and leave it as is and see how well it does with after all the fees. So in 2015, it went up 2.47%. This is how much we'd have before fees. This is what your fee would be using 2.13%, and then this is how much you would have after 1 year. Not that great, but the next year we start off with that same amount. It goes up 8%, which is pretty decent, and this is how much we'd have before fees, after the fees, and then the same story. And even you can see here on this year, guys, it went down 6%, but we still paid quite a bit in fees. So after the 5 years, we would have made about $14,000, or let's say $15,000, but we've also paid about how much, like $10,000 or so in fees. So we gave up almost half of our gains to fees. That's not very productive, right, or very efficient. Now, can you imagine if we didn't have to pay fees or we didn't pay nearly as much? This 102, for instance, we would have started off the next year, and then that would have gone to the 8%, and then so on and so forth. And it would just continue to be reinvested every year instead of the money just disappearing, right? So not very efficient in my opinion. And it's not even that the asset allocation is even that bad either. It's not my favorite per se. However, you can get baskets like this for much cheaper, as we'll see in a moment. Level 2, we have Robo Advisors. So they are just as little effort as mutual funds are. However, the fees are significantly less. We're talking 0.2 to 0.5% versus 2 2.5%, 1.5%, whatever mutual funds can be. Robo Advisors are pretty straightforward. They ask you a bunch of questions at the beginning. What are your goals? What's your time horizon? How risky do you want to be? And then depending on your answers, they'll create a portfolio for you, and then you fund your account, and that's it. So I'm going to use this as an example again. So we're going to put 100,000 in. Same thing as before. We're going to assume that we're not putting any money in. We're just going to put that lump sum in. And I chose risk level similar to the TD one, which is growth. And then I just chose 20 years here as an arbitrary number. So as you can see here, a huge difference, guys, and that's mainly because of the fees. Look at how much you'd be paying with Quest Wealth and how much you'd be paying with the average mutual fund fee, sorry. And it's a big difference. What is it, like $80,000 difference over 20 years because of fees? So most of the money you would have been paying in fees you get to keep, and it's reinvested year over year over year. And you can see the difference. Let's say we put 30 years, for instance. The gap is even that much bigger, right? So imagine someone in mutual funds, and every year they're getting 2%, 2%, 2%. Over 40 years, that's a lot of money that you could have kept for yourself. Why pay the bank? Why not pay yourself? As well, we have Wealthsimple Invest, not to be confused with Wealthsimple Trade, which we'll talk about later on. Essentially, it's the same thing as Quest Wealth. You do pay a little bit more. However, it is very user-friendly, but I'll make another video in the future comparing the two. Alright guys, this is when it starts to get really fun. So level 3, we have exchange traded funds, also known as ETFs. So what are they? They are essentially the same thing as mutual funds in the sense that they're baskets of stocks, as you can see here. However, there are some major differences. So they are traded like stocks on exchanges, hence the name exchange traded funds. So the same way you could buy stocks off the New York Stock Exchange or the NASDAQ or the Toronto Stock Exchange, you can buy and sell these baskets of stocks the exact same way. They do require you to open up your own self-directed investing account. So whether that's with Questrade, which is the same company as Quest Wealth, or Wealthsimple Trade, which again is different than Wealthsimple Invest. The other one, which is yellow, is the Robo Advisor, whereas this one is the do-it-yourself. And you can also open your own self-directed account with your own bank. I started off with Wealthsimple, and I ended up switching to Questrade. Wealthsimple is still a fantastic brokerage to use. It just didn't fit my goals. Again, I'm going to make another video comparing the two. So why ETFs? Why these baskets of stocks? Because they're an easy way to diversify instead of picking your own stocks. And what's so important about diversification is that it lowers your risk. And as the famous Warren Buffett has said, diversification is protection against ignorance. Another benefit of ETFs and why they're so popular is that they're passively managed. So unlike mutual funds where you have an active manager selling those ones that are doing really well and buying the ones that are doing not so well, is that this is statistically better if you just leave it alone. I've divided up ETFs into two different levels, level 3.1 and level 3.2. So level 3.1, we have all-in-one ETFs. They give off mutual fund vibes. They're like mutual funds in the sense that you buy one and that's it. So it's a basket of baskets. So you see here, for instance, with HGrow, within this basket, we have 3 other baskets. Within this one, we have 3 other different baskets, right? And the difference between level 3.1 and level 2, for instance, is that you have more autonomy. You get to choose which basket of baskets you want. So one of my favorite basket of baskets, I don't invest in it personally, but it is my favorite if I were to choose one. It's called HGrow, also known as Horizons Growth Tri ETF. The management expense ratio is 0.17%. However, don't be fooled because the underlying baskets that HGrow holds, you do pay the fee indirectly, so it ends up being about 0.5%. So this is a little bit misleading, but it's still much better than 2.13%, for instance. And moving on down, guys, we see the baskets within the HGrow basket. So about 33% are in the largest US companies, 22.7% are in the NASDAQ 100, and one thing to note is that there are a lot of companies that overlap between these two, so you get additional exposure. And then 21% in international markets, 16% in Canada, and about 7% in Europe. So very diversified. There's probably like 10,000 plus companies. So if one company does really badly, you're okay because you still have another 9,999 plus. Another example, guys, is we have from a different company, we have BlackRock's iShare Core Equity ETF. So similar thing, it's an all-in-one. The fee is 0.2%. Again, I don't know if you get indirectly charged for the underlying ones, but either way, it'll still be way cheaper than if you were to get a mutual fund. And again, so here you have the US companies, about 47%, international, which is 24%, Canadian 24%, and then emerging markets 5%. All right, and we have level 3.2, picking your own baskets. So this is significantly more autonomous in the sense that you need to do a lot more due diligence and research when picking your baskets versus the all-in-one ETFs that are super diversified. Now, these baskets are pretty diversified in their own, but when it comes to do you want 30% in US stocks or do you want only 15%, that's where you have to do your research. And there are thousands of different ETFs out there. So some are as large as 10,000 different companies, some have maybe 50 or 30 or 20 or whatever that particular ETF has. So the most popular ETFs out there are ETFs that mirror the S&P 500. And it shows here the different weighting and all the different companies that you would be holding. And you can buy them. So VOO, I think it charges about 0.03%, which is essentially nothing. And it's in US dollars. And you have VFV, which is the exact same thing but in Canadian dollars. So it's good for Canadian investors if you want US exposure without having to convert your money. And I believe VFE is about 0.09% versus the 2+% you're paying with mutual funds. Same thing with the NASDAQ. You have ETFs that mirror that one as well. So QQQ is the one that's in US dollars, and we have that over here. So again, a lot of overlapping companies. They just make up a larger portion. If you've watched my previous videos, you'll know that the NASDAQ is comprised of the 100 biggest US companies minus financials. XQQ and QQC are the exact same thing but in Canadian. The major difference between both of them is that QQC.F is, I think, 0.25% a fee, and XQQ is 0.35%. And the difference in how well they do is like very negligible. Do your own research, see which one's better for you. I don't invest in either of them personally. And lastly, I have to touch upon this because I know my friend Chris will not like it if I don't, is another ETF called ARK. So ARK invests in companies that are innovative in nature and disruptive to the way the world works today, I guess. So you see words here like genomic revolution, industrial innovation, next generation internet, fintech, and innovation. So if this does interest you, definitely take the time to read it, see what they're about. It might be worth your while. And this one, guys, this is where it's at. Level 4, we have stock picking. So this is what Steady Invest is all about and what we'll be talking about for most of my videos. I will dabble into ETFs because I have done quite a bit of research, especially Canadian ones. I'll definitely make some videos about that. But yes, level 4, stock picking. So the first thing is there's no fees. There's no management expense ratio or anything. You're managing it yourself. You're buying them. You can buy and hold, do whatever you want. But there's no fees for having to hold a particular stock. There are commission fees when buying stocks, but that's independent of buying a stock and then being charged to hold it for however long you want to. So stock picking is riskier in nature because you're picking single companies. It's not like you're diversifying. I mean, you don't just buy one stock, but make your own portfolio, but you're choosing your own risk essentially. Remember, with the stock market, risk always correlates with reward. So if you take a strategic approach to your risk, your rewards could pay dividends. And it goes without saying, guys, it requires significantly more research than all 3 previous levels. As you guys are aware, I got a new computer, and I got, for the first time in a decade, an AMD processor. Why? Because 5, 6, 7 years ago, AMD used to suck. They were about to go bankrupt, and then this wonderful lady named Lisa Su essentially took over. She became CEO and turned around the entire company around. So if you did your research at the time, looked into Lisa Su, looked into what she was doing, you'd be like, you know what, she's turning it around. You know what, let me invest in them right now when they're $1, $2, whatever. If you invested in them 5 years ago today, you would have made up to today about 4,000%. So again, it would have been pretty risky at the time because they were always going bankrupt. So depending on your strategy and how risk averse you are, you may not want to always be investing in companies that are about to go bankrupt. I mean, me personally, I invest in companies that I think will do really well in the long term. I think I was on Reddit and I was reading a post where some guy said he invested at this point. He's like, today I'm retiring. I never have to work another day in my life. So I think that's a little bit more of an extreme example, but it just kind of shows the power of stocks and the wealth that can be generated from it. Now, what kind of YouTuber would I be if I didn't talk about Tesla stock? So you can see here, it did pretty much nothing for about a decade. And then right before the virus occurred, we had a nice little run up, and then it crashed during the market crash. And then if you got in then, you would have made about 400% in about 6 months. So not bad. One of my favorite YouTubers, Financial Education, bought Tesla stock. So he posted this video before the stock split. So at this day, it was trading at $2,153 US. He bought it 2 years prior to this video, roughly, for about $227 a share. He put in about $34,000 US in it. And since then, the gentleman has made about 850%. Also, that would be about $288,000 US dollars over 2 years. Not bad. One last quick example, guys. This was a trade I was thinking about making because I'm like, you know what, the PS5s are going to be coming out, whatever, but because things are going more digital and there's not going to be as many physical games out there, I don't know if I want to do it. Should have done it. I mean, in hindsight, yeah, but this would have been out also in 6 months. Didn't take it, but again, just shows the power of stocks and the wealth that can be generated. And lastly, guys, as a bonus level, we have something called options. I mean, there's also futures. There's so many different types of investment vehicles. Me personally, I don't understand how any of those things work. Options are something that I do want to get into eventually. However, how options have been described to me are you're buying risk. So again, I don't understand how it works. It is something I want to get into, but I would only buy an option or take an option or whatever you call it, only if I believe the option I'm taking is a slam dunk. But again, that's whenever I start understanding it, maybe I'll start posting videos about it one day. As always, it comes down to what your goals are. And depending on what they are, they'll dictate what kind of strategy you should take. So how much risk you're willing to take and how long you want to invest for. As always, guys, thank you very much. My subscriber count is slowly getting higher and higher, so thank you for all the support. If you're new to the channel or you haven't already, please subscribe. Guys, comment and like below. And if you guys want to start your own self-directed investment account with either Wealthsimple Trade or Questrade, you can use my link below and we'll both get $10, $20, $30, $40, $50 worth depending on how much money you put in and which brokerage you go with. So again, steady invest. My name is Adam and see you guys next time.